Now, moving on, of all the government bonds that sold off in the past month, gilts in the UK and U.S. Treasuries were among the worst performers. There's been a bit of a rebound so far in 2010, but not much. We partner with the Financial Times to bring you Lex on Bloomberg so you can get a sneak peek at the FT's flagship column a day early. Paul Rathbone joins me now live from London. Paul, you've been taking a look at why these government bond markets are having such a tough time lately. What have you found?
Well, it's true that all government bonds generally around the world are having a bit of a tough time as growth prospects seem to be improving, and the US and the UK have been particularly poor performers. It's not necessarily to do with the state of their public finances. It's more to do with the probability that central banks will stop their quantitative easing policies. And basically, in the nub, once the central banks stop buying government bonds, the burden falls on private investors to finance the deficit, and it would seem that investors aren't necessarily up to the task, and that's why yields have risen, because the number of buyers have fallen.
So this is really effectively, in your analysis, all about the end of quantitative easing.
I think QE is the elephant in the room. I mean, arguably, for investors, it's the sole factor that really matters going ahead in the year to come. If QE, or when QE stops, bond yields presumably will rise as the buyer of last resort, the central bank, steps back, and that will have a knock-on effect on bond prices, stock market valuations, and all assets.
Now, Paul, very briefly, what are the credit default swaps telling us about the prospects for these government bond markets?
Well, credit default swaps is a rather anomalous market in the sense that they're measuring default risk on foreign currency bonds. But the UK and the US have domestic currency bonds. So, in a sense, there is no default risk because the governments can always print more money. Where there is a default risk, perhaps, is in countries that can't finance themselves with their own currencies, and that really points towards Eurozone governments. They can't print euros, that's the ECB jobs, and they also don't lack the near zero interest rates of the ECB of Japan.
I'm afraid we've run out of time, Paul. My apologies. We'll catch up with the Lex desk once again tomorrow, folks, right here on Bloomberg.